kindly come in to answer some questions and let us know what's going on in the current mortgage market. There's been quite a lot of changes since Liz Truss was Prime Minister, remember her? And her mini budget, which changed things quite a lot. So really we had a really scary spell towards the end of last year after that mini budget where there was a lot of turbulence. And thankfully things have changed for the positive since then. But I wanted to ask an expert, and Tom is one of those, where we were, where we're at and where Tom thinks we're going. So firstly, Tom, it was quite scary when the mortgage rates suddenly jumped up and we're hearing stories about 7.5s and 8s.
Yeah.
Lenders pulling products, was that a thing?
It was. So back end of last year, obviously when the mini budget did happen, it did just completely change the whole market. We've seen that it has slowed down back end of last year, and certainly beginning of this year, lenders are now a bit more stable. They know kind of what's happening, what's going on. So rates, if anything, are coming down slightly. The base rate is going to go back up, but that's not necessarily going to mean that the rates are going to go back up either. That's really just to control the inflation. But certainly what we found the last few weeks is lenders bringing more products in, lower interest rates. They were at the 6s and 7s last year, but you'd find now you're probably looking, depending on obviously deposit levels and equity and the loan to value, you probably are looking between 5, 5.5. There are some in the 4s as well, and I think their plan is to kind of have headlining rates at kind of the 4% this year, which, don't get me wrong, is a lot more than what it was 2 years ago when people were doing 1.5%, 2% deals. So yeah, it's had a big impact. It's going to take a while for it to get back to what it was, or somewhere near where it was. But yeah, there's good signs that it's stabilising and rates are coming a little bit further.
We've certainly noticed a big uptake in first-time buyers since probably the 3rd of January when we came back.
Yeah.
We didn't see a lot towards the end of last year, and I guess a lot of buyers were just waiting things out. Those buyers who had the rate fixed in from before the mini budget, who were eager to spend that money.
Yeah.
But we have noticed a huge upturn in younger first-time buyers. I've got this theory that rents are rising still, and first-time buyers are managing their budgets and their expectations, but they're still thinking that buying a property on a 5-year fixed rate is still the way to go.
Yeah, it's more important than ever. It's to get that right information, get the right advice, so speak to an independent financial advisor, mortgage advisor, obviously if it's the mortgage side, more than ever, because there's a lot of misinformation. One week the kind of media are saying this and it's all doom and gloom. The next rates are coming down, but those rates and the deals that lenders are kind of introducing aren't really widely kind of advertised as such in the media. So a lot of people don't really know what's happening unless they obviously are buying a property in a minute, and do speak to someone that's independent that can give them an overview of everything that's happening. So I think there's more confidence now, because everyone knows that unfortunately cost of living, everything that's going on at the minute is here to stay for the short term anyway. But it is giving a little bit more confidence in the market, where people are saying, look, we still want to buy, we've got the money there, but it is a case of speaking to someone independent that will actually, especially now, relook at the figures, make sure that the budget is still where they want it to be. Because what you'll find, if you were looking, say 18 months ago, you might be looking at a 250 grand house and you went through the affordability with your mortgage advisor and it was fine. With the rates going up, affordability is tighter as well, because they need to make sure that you can actually pay that increased payment. So you might find that 250 grand kind of ideal home last year might be 200 this year. So I think it's a case of making sure that you've gone through the figures, budgets properly with someone that can tell you, to then go out and find that property, because it's not a case of it's all doom and gloom and there's no way buying properties, but it is really a case of being careful and adjusting your budgets to then still go and find your first home. So I think there's a lot more confidence and a little bit more knowledge now that people weren't probably accustomed to last year.
I think it's certainly proved the importance of going to a broker, in my opinion, because if you go direct to the bank, I'm hearing stories of 2 to 3 week waits to get into the bank, and then when you go to that high street bank, they're only talking to you about their particular products, which might or might not be suitable for you. But you know, how many banks and products would you say you've got access to compared to a bank?
Yeah, well, we've pretty much got access to the whole market, the whole UK market. So most people in my position will charge a fee of maybe £500, a few £100, or even £1,000. Obviously myself, I don't charge any fees at all. We do get paid by the lender for placing the business with them, which other mortgage advisors do, but also they decide to charge on top. So for me, I might need to work a little bit harder to get more clients on a referral basis, and obviously working with yourselves. But it's certainly for me, knowing that I'm going to someone's house, giving them a whole of market approach, making sure that we are looking at everything, and making sure that their kind of product is tailored to them and not actually charging a fee. But yeah, more importantly, it's getting that advice, because again, you can go to your bank, they might say that you got accepted and that your payments are affordable, which is great, but you also need to check that, is that the best? If it is the best, great. You might have just got lucky and it's your own bank, but also you might be going to a lender that is actually 6th or 7th cheapest at the time, and that actually could make quite a lot of difference in your monthly payments, and especially longer term if you're looking at a longer mortgage. But yeah, for most independent brokers like myself, we are quite available most days, weekends. Kind of appointments can be booked within the hour, whereas if you do go to your bank, it can be difficult. Don't get me wrong, it might not be difficult for some, but you're certainly going to be in there for a while, and they're not going to obviously give you the independent approach. They're just going to say, look, this is what we can do, so we can help, and it might not even be the answer you're looking for, and in that case it's certainly more important to then get that independent advice then.
What are you finding is the most popular at the moment in terms of fixed rates, variable rates, 2 or 5 years?
Yeah, so 2 years at the minute is becoming more kind of popular, because it's obviously we know that the rates are quite high at the minute, and if things kind of stabilise as they are and things get better, you might then find the rates in 18 months, 2 years time come down even further. So what that means then is if you're fixing for 2 years, you've got that option to review that deal in 2 years time. That deal's lower, great, you then fix it again for the 2 or the 5 year period. The flip side though, obviously we weren't expecting what was happening last year, so if something like that happens again and the rates shoot up again, you're then at risk of that rate then even going the opposite way. So it's a case of how probably that person is feeling about the market, and their kind of personal view on it.
So it's an attitude to risk as well, I suppose.
Yeah, and then the 5 year obviously gives you that certainty for a lot longer, but that rate might be quite high in comparison to what it may be in a couple of years. So you might be 2 years into that 5 year deal thinking, right, the rates have come down now, I can't really change my deal unless you pay to leave that deal early. So, but I think certainly if you want to know, especially if anything goes by the last 6 months or so, if you want to make sure you know what you're paying and you don't have any risks of that increasing, then certainly a longer term fixed rate is a lot better for that particular person, but it is all individual. So it is a case of, again, a lot of banks may not kind of expand as much on those deals and the pros and cons, because they are quite restricted in what they can say. But anyone independent can give that whole of market advice and just go into a little bit more detail about the risks involved in each of those deals, but also spend a little bit more time finding out what may be more beneficial to that particular person.
Interesting. So much has changed, and it's really interesting stuff, because you just don't get this when you get a headline in a newspaper and it doesn't really explain what's happening out there. And I'd say I'm very interested, clearly, because it's you know, if mortgages are freely available at low rates, I sell lots of houses, which is what I'm here for. Yeah. But it's really interesting that things have changed so much in just 3 or 4 months, from quite negative to, I think, becoming more positive.
Yeah, don't get me wrong, the rates aren't what they were before COVID and during COVID, but I think the older generation as such would probably understand that that wasn't the norm, and it's never been like that. But the first time buyers and the younger generation would probably think, great, this is what it's going to be for the rest of the term of the mortgage, which unfortunately it wasn't going to be. We were always going to see the rates come up, but not obviously as quickly as what it has. So it's escalated that rise, which hasn't been ideal short term for people, especially with existing mortgages that have had to pay a lot more than what they've been used to. But it's certainly stabilising. But yeah, it's getting that confidence back more so, and making sure that people are well informed, I think, is probably the most important factor.
We'll touch briefly on buy-to-let financing. How's that at the moment?
It's a little bit more difficult than the residential side, mainly because the kind of affordability on a residential and a buy-to-let are completely different. So buy-to-lets, obviously, they would be looking at rental income that's coming in. If you've got a portfolio, they will be looking at the whole portfolio overall to make sure that it's actually servicing well. But they will stress test that rental income a lot higher than what a residential lender would do on their mortgage payment, because what they want to do is, if the rates did go up to a certain level, which at the minute they're stress testing at 7-8%. So what I mean by that is, if the rates did go up to that level, they want to make sure that that rental income would actually cover that mortgage payment.
Got you.
So they are stress testing it probably a lot higher than what they need to be. But I think the buy-to-let market is probably a little bit behind, in a sense where the confidence probably isn't there just yet for them to relax that. But as soon as they do relax that, that means then it's going to be a lot easier for people to buy a buy-to-let.
Rents are increasing because of the lack of supply, so that should hopefully help with
it's hand in hand then. Obviously, if the stress test comes down and the rents go up, that'll then bring a lot more stability, and it should be a lot easier for buy-to-let landlords in general to get those mortgages. But again, that is another side where, if you are looking at buying a portfolio, or starting a portfolio, or remortgaging an existing portfolio, you're not going to be able to go to Halifax and put all your cards on the table and them to kind of give you a solution. That is again another independent approach that would be needed, and there's a lot of things that you can do to kind of make it easier, make it more attractive for lenders. But obviously it's knowing what these lenders are doing and how they're assessing it. That's the most important thing to help you with that mortgage then.
I'm just obviously thinking of the people watching now, so I'm trying to throw as many questions, I apologise, at you that they may be thinking behind the screen. So I'm a first-time buyer, aspiring to buy a property. What's the minimum deposit that you really need at the moment?
So it is still 5%, so they did kind of disappear during COVID, because obviously property prices were potentially on the way down and they weren't sure what was happening. But the 5% deposit mortgages are readily available. Generally, you can't borrow as much as you would if you had 10%, but obviously if you do go through the figures with an independent mortgage advisor, they will be able to let you know the differences and whether it would affect anything and whether you would need that 10%. But you've got obviously Help to Buy Wales, which obviously at the minute is obviously just in Wales. Help to Buy England's ended, so you still can buy a new build at 5% with Help to Buy as well, up to 250 at the minute, but 300 in April in Wales. But even if it was a standard property, it's still 5%. Obviously you'll have a bigger mortgage, so you would need to make sure that that is affordable, and obviously speak to someone that can let you know about that. But yeah, it's still 5%, so the products are there, the availability is there, which again during COVID wasn't. So lenders are willing to lend and they really want to be competitive as possible. So it's not a case of there's no properties and no mortgage lenders. There's probably not enough properties, there's a lot of products out there, and it's just a case of getting addicted to Rightmove and speaking to local estate agents, because there will be, the availability is there.
More stock's going to come on.
Definitely.
And I noticed sort of towards the end of last year when the rates shot up, they shot up for everybody. And for the last 4 or 5 years, the rates have been very different if you've got a large deposit or lots of equity in your house, if you've got a lot of profit in the house. Towards the end of last year, the banks didn't seem to make a big difference on their rates.
No.
Has that changed now? If I've got a large deposit, is my rate going to be lower than if I've got a small deposit?
It will be. So the biggest jump is from a 95% mortgage or 5% deposit to 15% potentially. So what you'll find is if you've got a 5% deposit, you will be at the higher end of the scale. So you're probably looking 6%, 6.5% at the minute. You go down to 10%, you're probably looking 5.5%. So there's still a bit of a difference in the rates. And then as you kind of cascade down, you are probably looking into your 4s, but that probably won't happen until you've maybe got 30, 40, 50% equity or deposit. But historically, there was a lot of a real big difference really in those kind of brackets. But it's one of those, I think you've got to be careful in, you don't want to put everything down, because obviously at the minute you still want a safety net, you still want disposable income there if the worst was going to happen in terms of bills going up and things. And it's just a case of working out the difference in the payments, because what you might find is you put another 10 grand down but you're only saving £100 a month. So would you rather that 10 grand sat there and kind of
do kitchen in or something?
Or would you rather actually get your mortgage payments down as much as you can? So there's definitely rates that obviously the more deposit you've got, the more equity you've got, they are going to come down.
Yeah.
But I think it's working out whether actually that is going to be beneficial to you in terms of the monthly payments that you'll be saving. But obviously generally overall though, if you're looking at a 30-year cycle, it's going to save a lot more. But short term, especially if you're looking to do work to the property and add value to it, you might then be focusing on adding value to that property to then in 2 years time potentially get a better rate that way. So there's a lot of things you can do to reduce that interest rate potentially. But yeah, certainly from a 5% to a 10, 15%, there is a bit of a difference.
But it depends again how long you're going to stay. So if someone's looking to do a house up over a couple of years, make a bit of money and sell it on, and maybe putting less money down, it could be the way forward in certain circumstances.
I think if you're buying something that you know that you're going to add value to, and you've done your research, spoken to estate agents, you know what that end value will be once you've done X, Y, Z, it may be better to retain that money, put a minimum deposit down, add that value to that property, and then all of a sudden then you've built all that equity up that you wouldn't have had, which inevitably then is going to help you get a better interest rate whenever your deal's due. Or if the plan is to sell it, you've then got a bit of equity then to buy another property with. So it's not necessarily, a lot of people say you need to get 10%, 15%, and that's always been kind of the general advice of put as much down as possible. But also you need to then make sure that you're not moving into property and got no money left, because you've ultimately still need a safety net, especially obviously at the minute with bills going up. But also if there is value to be added to that property, that might be more beneficial for you to put the smaller deposit down and actually add the value to that property that way.
I've never looked at it that way, so it's really interesting looking at it that way. Another question I thought of, if I, not me personally, but you know, people watching this who live in a house at the moment and their 2 or 5 year fixed rate is due up this year, and they might be a little bit nervous because obviously they perhaps got that rate at the extremely good times. What's your advice in terms of how long before that mortgage rate runs out should they be speaking to you?
Yeah, so it's a good 6 months before.
Right.
So previously it may have been 3 or 4 months before, mainly because there wasn't lenders out there that could actually offer you a 6-month mortgage offer to tie in for when your existing deal ends. But nowadays we can secure mortgage products elsewhere for 6 months, which will tie in for that period. And then also what I do personally is speak to my clients 6 months before the deal ends. We might not be able to look at their existing lenders' availability until 4 months before. But if people are in a position where they want to secure something now, we can secure the cheapest on the market 6 months before. 2 months down the line then look at their existing lender, compare the two. And what happened obviously last year is the one we secured first was a lot lower than the other one, because obviously the rates were going up at quite a high rate. So me personally, I would be encouraging people to secure what they can now, then review it again with their existing lender when they can, compare the two, but also monitor the market. So if you have got an independent mortgage advisor that you work with, they should be looking at that for you, managing that, and actually letting you know when these rates come down. Obviously the only downside of doing it yourself or going to the bank, they're not actively going to contact you if things get better. They'll just leave you on that product that they secured. So that's another reason really to use an independent mortgage advisor to manage that for you, but then obviously going forward when the new deal is due, to contact you again 6 months before. So more so than ever, it's managing the mortgage as much as you can, getting advice as much as you can, but then also you've got that 6 month window to prepare yourself for any increase in payment. So cut back where you can, and just prepare yourself for that increase that inevitably, unfortunately, will be for most people that secured rates 2-3 years ago.
The good news is the house should have gone up in value, so they'll have more equity. They'll have paid quite a lot of mortgage off, so the loan to value will be different. That's the positive in there. And your predictions this year then, realistically, is we're going to get interest rates going up a little bit, and then hopefully coming back down again.
Yeah, so the base rate is, well, looking like it will go up again to maybe 4.5%. Historically, that would mean that the rates for the mortgage deals would go up as well in line with that. However, that's probably not going to be the case, mainly because the Bank of England base rate is going up because they're trying to control the inflation. And what we're seeing at the minute is rates coming down. So there's been big jumps and then smaller jumps, but then obviously every lender wants or has a certain amount of money available to spend per quarter, per annum. So they want to be as competitive as possible and actually hit their targets as well. So what you're finding is if one lender reduces rates, the other will follow because they don't want to be missing out on business. But I think at the minute you're looking at headline, say 10% deposit, you're looking 5.5%. I think lenders ideally want to be 4.5%, 4% this year. It might take longer than that because obviously with inflation at the minute still, but I think they are coming down. I can't see them going back up. I think they'll either stabilise or slightly decrease from where they are at the minute.
And for context, for us older people out there, I talked to a lot of clients who were around in the sort of early 90s, who would tell me about interest rates of 15% and more. Yeah. And I remember at the start of my career, which was in the mid-90s, when it was typical, the interest rate was somewhere around 5.75, 6%. So historically, we're still in a good place. Mm-hmm. We've just been in a really, really good place. We've been very spoiled for too long, and we've got used to those low interest rates, which aren't long term. So this is the new normal, but it sounds to me like we're getting more positive. Mm-hmm. I've certainly seen the market being more positive, and I think what we're going to have is quite a stable year where prices won't shoot up, I don't think, as much as they have done in the last 2 or 3 years. Mm-hmm. There'll be more gradual growth as people get to grips with the affordability of their mortgage and cost of living. But also there's still that lack of supply of available property, and increase in rents and lack of supply in rental property means that people, sometimes it's better to buy than be in a rental property where you've no chance of saving up. But I would say that because I sell houses for a living, so I'm biased. But I'd like to, on record, thank Tom for his time today, because this sort of free advice is really, really great advice, which I wish, when I was a young first-time buyer, this sort of thing was available. Because like I say, you can go to your bank, but it's going to take you a long time. But I hope some of the pointers that we've given you today just gives you a little bit of an idea of where we are at the moment, where we're going. And also I think, and I've always said this not just because Tom's in the room with me, but I think going with a broker, an independent broker, I've always used one personally. I've never gone to a bank direct ever in my whole life. I've done many mortgages. I believe if you've got a toothache, you go to the dentist. If you need your mortgage sorting, you go to an independent mortgage advisor. That's what they do for a living. They're the experts. I'm an estate agent, but they know an awful lot more than I do about interest rates, mortgages, and products. So whatever you're doing, take advice from an independent broker is my best advice from a personal level. So thanks very much, Tom, for taking the time to come in today. And I hope you've enjoyed and found this informative. Thank you.